Hi and welcome to section 4.1 for Econ 2 on the AQA exam board. Today we'll be looking at monetary policy. But what is monetary policy? Monetary policy is the process by which the monetary authority of a country, like the central bank or currency board, controls the supply of money, often targeting an inflation rate or interest rate to ensure price stability and general trust in the currency in an economy. In the UK, monetary policy is carried out by the Bank of England, and they have an objective which is set by the UK government to make sure inflation is 2% plus or minus 1% away from this. The Bank of England is independent, meaning that the government has no control over it, apart from setting the inflation target for the Bank of England. This means that the government cannot influence interest rates or the supply of money in the economy. The most common tool of monetary policy is changing base interest rates. However, monetary authorities also have other tools at their disposal, such as quantitative easing, which we will look at later on in this video. Monetary policy has a lag before it has an effect in the economy. This lag is between 18 and 24 months. Therefore, central banks need to predict what inflation will be in 18 to 24 months and act accordingly now to move inflation towards the target rate. They will also look at a variety of other factors in the economy, such as the unemployment rate, consumer confidence, the exchange rate, economic growth, changes in house prices, the level of private debt, investment, and many more variables. Like I mentioned earlier, conventional monetary policy centres around interest rates. An increase in interest rates would affect AD in the following. A rise in interest rates would cause consumption to fall. This is because an increase in interest rates makes consumption in the present period relatively costly in comparison to the future. This means that consumers may choose to save rather than consume now. Also, individuals who have a low income may choose to borrow now for consumption and pay this back in the future. A rise in interest rates makes this more expensive, and this puts consumers off. So consumption falls for potential borrowers as they choose to borrow a lower amount because it is more expensive. In addition, an increase in interest rates makes the interest payments more expensive for existing borrowers, and this reduces their disposable income, which reduces consumption. For example, if a household was on a tracker mortgage whereby the interest rate tracked the base rate, a rise in the base rate would cause interest payments on the mortgage to increase. This would reduce the amount of income that this individual/household would have, and this would reduce consumption for this household. Therefore, consumption falls as interest rates rise. Investment would also fall if there were higher interest rates. This is because higher interest rates increase the cost of investment if the investment is funded by borrowing. This makes investment from borrowing less attractive, and therefore investment falls. Furthermore, an increase in interest rates encourage firms to choose to save their profits rather than choosing to invest their profits in a new activity or to grow their business. This is because there is a greater reward for saving their money because of the higher interest rates. Therefore, investment falls when there is an increase in interest rates. The effect of an increase in interest rates on the government is unsure. This is because government expenditure may or may not change in response to this rise in interest rates. If interest rates rise, it may make it more expensive for governments to borrow because investors will place their money in bank accounts rather than placing their money in government bonds, as the interest rates in bank accounts are higher. Because of this, it may be the case that the government has to increase the interest that they are paying on their government bonds. and this may discourage governments from borrowing in order to consume goods and services. However, we cannot say what the government will choose to do with regard to spending. Therefore, we'll just assume that government expenditure will remain constant. The last two components of aggregate demand are exports and imports. These are linked together. A rise in interest rates may cause money to rush into the country that has increased their interest rates. This is because cash in the country that has increased their interest rates will get a greater reward through higher interest. This increase in demand for the currency causes the exchange rate to rise. A rise in the exchange rate makes goods and services in that country relatively more expensive for foreigners. This will cause exports in the economy that has increased their interest rates to fall. Imports will rise. This is because a higher interest rate causes the exchange rate to rise, which makes foreign goods and services now relatively cheaper. Thus, more will be consumed and imports will rise. The overall effect on aggregate demand is that an increase in interest rates would cause aggregate demand to shift inwards. AD would shift to the left, which is represented by AD1 moving to AD2. The opposite would occur if there was a reduction in interest rates. Consumption would rise as there is less of a reward to save for future periods. Also, it is cheaper to borrow to consume now as you have to pay less interest. Investment would also rise. One of the reasons for this is because a lower interest rate makes the cost of borrowing in order to invest lower, which encourages more investment. Also, a lower interest rate reduces the incentives for firms to save their profit and get interest on that profit, and instead makes investment projects such as expanding or setting up a new plant more attractive, and therefore a lower interest rate encourages firms to invest. We are unsure what the effect will be on the government, so we just assume the government expenditure remains constant. Exports will rise and imports will fall. This is because a decrease in the interest rate would cause money to move from this currency to other currencies because there is a greater reward from the money being in other currencies, because other currencies will have a relatively high interest rate. This causes the exchange rate to depreciate, which means that exports are cheaper, which causes exports to rise, and imports are more expensive, which causes imports to fall. The overall effect of a reduction in interest rate will cause aggregate demand to shift outwards. This is because consumption, investment, and exports rise and imports fall. Now let's look at a monetary policy response. If monetary policy authorities believe that inflation in 18 to 24 months will be above the 2% target because the economy is starting to overheat, they may choose to adopt a tight or contractionary monetary policy. An example of a contractionary monetary policy would be raising interest rates. If monetary authorities believe that inflation will become too low, they would adopt loose or expansionary monetary policy. An example of this would be to lower interest rates. Let's have a look at an example of the Bank of England's response to a crisis. After the financial crisis, the Bank of England lowered interest rates to try to stimulate the economy, as they believed that such a lack of demand would cause inflation to become below the 2% target, and inflation may have even turned into deflation. Before the financial crisis, the Bank of England's base rate was around 5%, but as soon as the financial crisis hit, they dropped the base rate gradually down to 0.5%. Many other central banks across the world also lowered their base interest rates, such as the Federal Reserve in America and the European Central Bank in Europe. After the Brexit vote, the Bank of England lowered the base rate even further to 0.25% amid fears that the impact of Brexit would have an adverse effect on the economy. However, one of the issues with using interest rates as a monetary policy tool is that there is a zero lower bound. This means that interest rates cannot be negative. So the Bank of England now has their interest rate at 0.25%. They would probably not be able to lower it to 0% or minus 0.25%. This is because it is really hard to impose negative interest rates in an economy where there is physical money. Physical money meaning notes and coins. This is because if you have a negative interest rate, individuals will choose to take their money out of saving accounts and keep it at home in a safe or put it under their bed. This is because a negative interest rate states that you owe the bank money for them keeping your money safe. I.e., if there was a negative interest rate of 1% and you had £100, if you deposited that £100 a year ago and went to collect it now, you would owe the bank 1% of that in order for them to keep your money, which would mean you would only get £99 back. So with an economy with physical money, any rational individual would keep that money at home because that £100 will still be £100 in a year's time. It will not fall in nominal value. Therefore, there is a zero lower bound when there is physical money in the economy. If an economy only had electronic money on bank accounts, and everything was paid for on card, they could impose negative interest rates on savers and borrowers. But no economy solely uses electronic money. This means that central banks have a zero lower bound for interest rates. This leads to central banks having to use unconventional monetary policy. One example of unconventional monetary policy is quantitative easing. This is where the Bank of England creates new money which it will then pay back in the future. It uses this new money to buy financial assets such as government or corporate bonds. The Bank of England buys these government and corporate bonds off financial institutions, which are banks. The Bank of England was involved in many quantitative easing rounds after the financial crisis. Quantitative easing was carried out after the financial crisis because many banks were unwilling to lend to consumers and firms. The hope was that as the Bank of England was buying financial assets from these banks, the banks would then have more money which would then be lent out to consumers and firms. Many economists have been sceptical about the effects that quantitative easing has had. This is because many economists argue that quantitative easing has caused many asset bubbles across the world, such as asset bubbles in stocks and house prices. Monetary authorities can also control the amount of credit that banks are able to give out. The Bank of England has recently brought in a policy that only 15% of mortgage approvals can be of values above 4 times of an individual's income. This is in an attempt to control the level of private debt which grew during the 2000s and was one of, if not the main cause of, the financial crisis.